Moving on to another exercise, we will look at the impact of each of these equity transactions on total stockholders' equity, assets, and liabilities. That's on your balance sheet. I'll do each of these by first recording the journal entry and demonstrating what the effect's going to be on assets, liabilities, and owner's equity. So the first one is when you issue common stock, what happens? When you issue common stock, you collect cash from the shareholders, they're giving you cash. You credit common stock only to the extent of the par value if it is known. Anything extra that was paid is credited to additional paid-in capital. Both of these are equity accounts. Common stock and additional paid-in capital are equity accounts. Again, just to refresh our memory, if by any chance you have forgotten this, hopefully by this point of time, we should know this. Let's use the acronym DEAD. I've told you this in class what it stands for, DEAD. We debit all expenses, assets, and dividends. So what do we have that's credited? You have revenues, liabilities, and equity accounts that are credited. Cash is an asset, it's being debited. So my cash is going to increase. Both common stock and paid-in capital are equity accounts. Normal balance is credit. Since I'm crediting them, it means those are increasing. This has nothing to do with liabilities, so there is no effect on liabilities. Same thing for preferred stock. It's identical to this in terms of how we set up our journal entry and what we do. Cash debit, preferred stock, par value credit, additional paid-in capital, if any extra was paid, we credit that. So again, the same thing as we had for issuing common stock. Assets increase, equity increases, no effect on my liabilities. The third one I'm told is what happens when I issue treasury stock? When I purchase treasury stock, when I buy back my own stock, common stock, my journal entry is treasury stock debit. I don't debit common stock, treasury stock debit, cash credit. My cash is decreasing. I'm paying cash. Cash is decreasing. I've credited it. Treasury stock is a contra equity account, which means it's going to decrease my equity account. When that increases, my equity account decreases. Again, no impact on my liabilities. I resell the stock that I had purchased. The treasury stock that I bought, the stocks that I bought, which I call treasury stocks, I'm selling those now. I'm selling it, I'm getting cash. Cash is debit. I'm giving up the treasury stock. The common stock that I'm giving up, I credit treasury stock. Whatever I had purchased it for at that price, if I got anything extra, I credit paid-in capital. Cash is an asset. Cash is increasing. Treasury stock is decreasing, which means equity is increasing. And if there's paid-in capital, that's an equity account, so that's going to increase as well. No effect on my liabilities. So this one, once again, let me explain. This is a contra equity account, treasury stock. So if that's decreasing, it means equity is increasing. Additional paid-in capital is an equity account. If that increases, equity increases. I declare and pay cash dividends. I declare and pay cash dividends. I declare cash dividends over here first. I first declare it and then I pay. So I have dividends debit, dividend payable credit. I've not paid cash as yet, so no effect over here. The next transaction I'll pay cash, no effect over here. Dividends payable is a liability. My liability is increasing. Dividends payable is a liability. My liability is increasing. Dividends are going to come out of retained earnings. Therefore, my stockholders' equity is decreasing. So in this case, the effect is on the balance sheet. When I look at the full balance sheet equation, there's no effect because assets, no change. On this side of the equation, liabilities goes up, but equity goes down. So they cancel out each other. So no effect at this point of time. When I pay the dividends, my journal entry is dividend payable debit and cash credit. So at this point of time, my cash is decreasing, so it goes down. My dividends payable is decreasing, liability is decreasing, that also goes down. This has no effect on the equity account now. Finally, we come down to these new concepts, stock dividend and stock splits. For stock dividends, what we're looking at is the company decides instead of giving cash to my shareholders, I'll just give them more stocks in the company. So it's effectively as if I sold it to the public, but I'm not selling it to them, I'm giving it to my existing shareholders. So here what we need to look at is this a large stock dividend or a small stock dividend? Because based on what we have over here, the journal entry I will do is going to be different. A large stock dividend means the number of shares that I have outstanding is going to increase by more than 25%. Small stock dividend means it's going to increase by less than 25%. That 25% is an arbitrary number that we've come up with. So 20 to 25%, we'll use 25% as a cutoff. So what this means is I debit dividends account, and what I credit over here is common stock. In this case, if it's a large stock dividend, we ignore market value, the market price or the market value of the stocks on the day we are selling when we are issuing the dividends. If it's a small stock dividend, we include market value of the stock on the day we are giving it to my shareholders. Dividend debit, common stock is credit at par value. Actually, it should be the same over here, common stock at par value. Okay. And additional patent capital credit. So effectively what we're doing over here really is we are saying if it's a stock dividend, small stock dividend, let's act as if I had sold it to the public that's outside of the current stockholders. How much would I have sold it for? That's how much I need to account for it. But if it's a large stock dividend, we don't do that. One of the reasons is because if you recall, what's your closing entry? Dividends are close to retained earnings. You're moving monies from one retained earnings from one equity account into another equity account. Here you are paying cash. You are paying cash when you were looking at cash dividends. But here I'm not giving cash, I'm giving stocks. So remember once again, go back to the simple thing. In the equity, we only two accounts, common stock and retained earnings. What are we doing over here? Moving monies from retained earnings into common stock. And for that reason, the small and large stock dividend becomes significant. So if it's 100% stock dividend, well, first of all, there's no effect on your cash, so don't worry about that. There's no effect on my liabilities. There's no effect on my owner's equity. There's no effect as in retained earnings is decreasing, common stock is increasing. That's in whether it's a small or a large stock dividend. Definitely, if it's 100% stock dividend, we're looking at a large stock dividend. But essentially, in the journal entry, you're moving money from retained earnings into common stock account, common stock and patent capital. Finally, let's look at the last one, 2-for-1 stock split. What does that mean? For every one share you have, we say you now have 2 shares. So how does that work? So think of this. You have a $10 bill with you. You change the $10 bill, you exchange it for two $5 bills. That's a 2-for-1 stock split. You're basically looking at still $10. It's just that you have two $5 bills with you. So I guess if you're one of those who likes to hold a lot of currency in your hand, you're going to get excited. Well, then you can do a 10-for-1 split. For every share you have, you now have 10 shares. You take your $10 bill and trade it for 10 $1 bills. Okay, so what is the effect we're going to have on our balance sheet when you have a stock split? Really nothing. Just the number of shares you have outstanding increases, but the par value is going to decrease. There are a variety of reasons why companies pay out stock dividends and due to the stock splits. Stock splits are typically done when the stock price is rising very rapidly and companies are concerned that people are going to say, the stock price is too high, I can't afford it, I don't want to risk putting my money in the share. The company will go in for a stock split. Just an interesting note for you, look at McDonald's, look at Apple and see the stock splits that they've gone through. How many stock splits have gone through, how rapidly they've gone through it, and why they went through those stock splits. So in this exercise, we looked at all the different equity transactions, what's the effect on the balance sheet.